The man running America's intelligence community has no national security experience, and yesterday he fired dozens of the career officials who do. $500 billion got wiped off global markets in a single session because investors are finally asking whether the AI boom is a bubble. And the executive who discovered Whitney Houston, signed Janis Joplin, and shaped American pop music for 7 decades died this week at 94. Let's get into all three. Start with the intelligence community, because what happened yesterday deserves to be named clearly for what it is. Bill Pulte, the acting director of national intelligence, a man whose actual job before this was running a housing finance regulator, fired 6 political appointees and removed more than 45 career intelligence officials from the office of the Director of National Intelligence yesterday. According to 4 sources who spoke to CNN, these weren't junior staffers. The 45 career officials were on joint duty assignment, meaning they were career professionals from other intelligence agencies temporarily stationed at ODNI, specifically to build cross-agency coordination, exactly the kind of institutional connective tissue that's supposed to prevent the agencies from operating in silos. They got sent back to their home offices. A source familiar with the planning says there could be another 24 firings coming in the next few weeks. Here's the part that matters most. 2 days before this happened, Senator Mark Warner and Representative Jim Himes, the top Democrats on the Senate and House Intelligence Committees, sent Pulte a letter warning him directly. "We are concerned by reports that you intend to fire or place on leave hundreds of Office of the Director of National Intelligence officers as soon as this week, and that doing so would risk jeopardizing the mission of an organization explicitly created after 9/11 to prevent any future such terrorist attack." Pulte read that warning and did it anyway, 2 days later. I want to be precise about why this office exists, because the justification being used to gut it inverts its entire purpose. ODNI was created specifically because the CIA, FBI, NSA, and other agencies weren't sharing information with each other before September 11th, and that stovepiping contributed directly to the failure to stop the attack. The entire institutional reason this office exists is to force coordination across agencies that have no natural incentive to coordinate. Pulte was installed with an explicit mandate from Trump to execute the immediate and needed downsizing of the office. And one Republican Senate staffer told CNN, approvingly, that Pulte being willing to rock the boat and send a bunch of people back to their agencies and gut the bureaucracy is a feature, not a bug for Republicans. Read that sentence again. Gutting the post-9/11 coordination mechanism is being described by people who support it as a feature. There's a legitimate argument buried somewhere in here. ODNI has faced real bipartisan criticism for years over bureaucratic bloat and unclear authority relative to the CIA. Trimming genuine waste is defensible, but that's not what 45 career professionals being sent back to their home agencies on short notice looks like. It looks like ideological score settling against an institution that parts of the MAGA right have decided, without much specific evidence, is deep state by definition, executed by a man with zero background in the field he's now restructuring, against the explicit warning of the people in Congress whose job is oversight. The next genuine intelligence failure this country has won't ask whether the cuts were popular with the base. It will ask whether the coordination mechanism built specifically to prevent it was still standing when it mattered. That's politics. Now to a much bigger number, and a much bigger question about whether the most important trade of the decade is starting to crack. Global stock markets got hammered yesterday, and the proximate cause was simple. Investors are suddenly, seriously asking whether AI valuations have gotten ahead of themselves. The Nasdaq dropped 2.21%, and the S&P 500 fell 1.44%. Both indexes' worst day in about 2 weeks. That's the mild version. The real panic happened in South Korea, where the KOSPI index collapsed 10% and tripped a circuit breaker, triggering a 20-minute trading halt for the first time since March. Samsung and SK Hynix, the 2 memory chip giants that together make up roughly half the entire KOSPI's market value, both fell more than 12%. Japan's Nikkei dropped 6%, and SoftBank, which has bet enormous sums on AI infrastructure, sank 15% in a single day. Across global markets, roughly $474 billion in value evaporated in one trading session. Here's why this matters beyond a scary headline. James Riley, senior markets economist at Capital Economics, put it plainly. These big moves are part of a growing trend of rising volatility in tech stocks generally. This volatility is, in our view, evidence of excessive froth and calls into question the sustainability of this rally. Froth is the word that matters. The entire AI infrastructure boom, the hundreds of billions being spent on data centers, the multi-billion-dollar compute leasing deals between companies like SpaceX, Google, and Anthropic that I've covered repeatedly this month. The chip orders stacking up years into the future. All of it rests on an assumption that demand for AI compute will keep growing fast enough to justify the spending. The moment serious money starts questioning that assumption out loud, you get exactly what happened yesterday. A 10% one-day move in a major national index on stocks that, as Riley notes, haven't dropped all that much in absolute terms yet. The Nasdaq is still up about 10% this year. This wasn't a crash. It was a tremor. But it's the kind of tremor that tells you the fault line is real. And there's a second pressure compounding this one that almost nobody connected to the AI story in yesterday's coverage. The Federal Reserve's own June projections show PCE inflation at 3.6%, nearly double the Fed's 2% target, with the federal funds rate now projected at 3.8% for the year. Higher rates do something very specific and very damaging to AI stocks in particular. These are companies valued almost entirely on profits investors expect years into the future. And higher rates shrink the present-day value of those distant profits more than they shrink the value of a company already generating steady cash today. So, you have two things converging at once: genuine doubt about whether AI spending will pay off, and a Fed that can't cut rates because inflation, driven significantly by this spring's energy shock, still hasn't cooperated. Either one of those pressures alone would be uncomfortable. Together, they're the combination that turns a correction into something worse. And now, because not every story this week needs to be a fight, a genuine loss. And a genuine legacy worth marking properly. Clive Davis died Monday at his home in New York City. He was 94. Davis started as a corporate lawyer, moved into Columbia Records' legal department almost by accident in 1960. And within 7 years was running the label. He's the executive who signed Janis Joplin, developed Bruce Springsteen, brought Santana and Chicago to mainstream audiences, and, after being pushed out of Columbia and rebuilding at the label he founded, Arista, discovered and shaped the career of Whitney Houston, one of the best-selling vocalists in American history. Across 7 decades, his roster included Aretha Franklin, The Grateful Dead, Alicia Keys, Carrie Underwood, and Kelly Clarkson. Aretha Franklin once called him the greatest record man of all time. He won 5 Grammys, was inducted into the Rock and Roll Hall of Fame as a non-performer in 2000, and founded NYU's Clive Davis Institute of Recorded Music in 2003 to formally teach the business side of an industry he'd spent decades mastering by instinct. Bruce Springsteen's tribute captures something specific about why people in the industry, not just the audience, are mourning him. At 22 years old, he changed my life when he signed me to Columbia Records. He treated me with the same respect and kindness as a 22-year-old nobody as he did after all my success. That's a different kind of legacy than chart numbers. It's about how he treated people before they were famous. Which is the part of the music business that almost never gets remembered accurately once someone's a legend. I don't have a critical angle here, and I'm not going to force one. A 94-year-old man who spent his entire adult life finding and believing in talent other people overlooked, and who by every account treated the people he discovered with consistency, whether they were nobodies or icons, doesn't need a counterpoint. He just needs to be remembered accurately. 3 stories today. An intelligence agency built specifically to prevent the next 9/11 just lost dozens of its career coordination staff to a man with no background in the field, over the explicit warning of the lawmakers whose job is to stop exactly that. $500 billion vanished from global markets in a single day because the world's biggest investors are starting to ask, seriously, whether the AI spending boom can actually deliver what it's promised. Right as the Federal Reserve's own numbers show it has no room to make borrowing cheaper if they're wrong. And a 94-year-old man who spent 7 decades finding talent other people missed, died this week, leaving behind nothing more complicated than genuine gratitude from the people he helped. 2 of those stories are about institutions and bets that may or may not hold up under pressure. The third is about something that already proved it could.